All right, what's up, guys? I hope you're doing well. I just want to continue to go over the recent monetary policy report. Basically, continuing on to the near and longer term inflation expectations, while also talking a bit about real GDP. Um, and so, basically, in expectations for average inflation over the next 5 to 10 years from the same survey flattened out in the second half of 2021 after having moved up modestly in the first half, and they now stand near levels observed about a decade ago. And this is all done with the University of Michigan surveys for consumers um, and stuff right there. Again, just continuing with the monetary policy report, but that increase was driven by higher expectations for the next 5 years, with expectations for inflation remaining at 2% over 6 through 10. So basically, near-term inflation. Let's see if we can actually see differentiate on the graph, and maybe I can zoom in without it looking so bad for you guys. Never mind. That's as much as we can get. Um, So for the next 12 months, it's this large, this dark, I guess dark blue, to where you see it skyrocket here, where you see 5%. Um, and then next 5 to 10 years looks like it's this one. Hopefully my mouse is, you guys can see that well enough. In 2022, at the far right of the end of the graph, it kind of crests above 3%. That's around there. And then you have let's see, the projected for the 10-year, or for like a 10-year period, it's around 2%. So it seems like, according to this survey, people believe that we're going to experience still high inflation in the next near term, especially in the past 12 months, with them expecting 5% at least. And then in the next 5 to 10 years, so kind of medium term, it seems, is like 3, but longer term, we're still expecting around 2. Excuse me, which kind of fits in with the whole disinflationary argument, because again, nothing goes up in a straight line. So, especially in terms of economics. And so, let's see, a measure of CPI inflation compensation over the next 5 years implied by Treasury inflation protected securities, the TIPS, continued to rise on net through the second half of 2021, reaching its highest level over the past decade. And this is basically the inflation compensation. So TIPS it's pretty self-explanatory in the name. Treasuries that are inflation protected, so like their yield follows the rate of inflation and stuff like that. So this is basically, you can look at those and see what the market is implying inflation will be by the yield on those bonds. You see the 5-year with this blue line is around 3%-ish. And you see, it doesn't state the exact date in which they stopped measuring, but it looks like 2021, the end of 2021. And then the 5 to 10 years still, it's between 2 and 2.5, so like 2.2-ish. So yeah, and then they talk a bit more about the Common Inflation Expectations, which is the CIE index, which is constructed by the Federal Reserve Board staff, combines a wide variety of inflation expectation measures, including the ones we've already talked about, and combines all of these into a single indicator. Let's see. Basically, trying to get multiple points of view, so also looking at like survey data, but also market data, time horizon, and the inflation measure, the actual inflation that they measure. And both of these indices, which is figure 12, which is probably, yeah, look most similar to the measures of longer term inflation expectations. So we see these in this one up here, where we have the CIE, where we have projected onto the 10-year, and then projected onto Michigan, which this is the one, this is the survey, and then this seems to be I'm not sure what SPF is. Survey of Professional Forecasters data, right there. So the one that's projecting onto the SPF ones, the survey of professional forecasters, is around 2%, and then the other one's about around 3%. The one that's on the Michigan data. Okay. And here's where I kind of have a little more to talk about, or at least that's not directly in the what they type. So the level, excuse me, the level of real GDP recovered further in the second half of 2021, but growth was somewhat slower on average than in the first half. So GDP growth is reported to have slowed notably to 2.3% at an annual rate in the third quarter, but rebounded at a brisk 7% in the fourth quarter. So here's a graph of the real GDP. We see what happens in 2020 and bounces back up. But the reason I think this is such a big deal, or I've heard that it's such a big deal, is I've heard people like Jeff Snyder and George Gammon a bit talk about how this is it's the trend that matters, right? And so even though, what was the argument? We're missing a lot of GDP in the end. And so, like, I apologize. I can't. I don't remember enough of the argument at the moment, or at least it's not coming to mind. I just got back from work, so not enough to really give much merit to it, I believe. But basically, by being below trend and everything else, and they looked at a lot more data. They compared this era to that of the Great Depression, and they showed like the 12-year period, and where we had looking at the 12-year period itself, going from, I don't remember the exact years, but within that period, start to finish, throughout encompassing the entire Great Depression, we had a real GDP growth of about 60%, right? Whereas if you look from here, I think it was from 2008 to 2020, or 2008 to, or 2010, somewhere a 12-year range or so in that, starting with the GFC and then going through to now, basically. I don't think it was even 20% in terms of real GDP growth, right? So by that metric, you'd say that the past 12 years or so have been 3 times worse than the Great Depression, at least in terms of real real GDP. Damn. It was a very interesting argument. It's something that I apparently really need to get back and read again or look over. Man, I am struggling. But anyways, this one was just meant to be kind of a quickie. That's pretty much it. That's all I got for this one. So hope you guys have a good day. See you.